Good. So hello and welcome to another edition of the ICAP webinar series, where we're looking at distributional effects of emissions trading. This is the 11th episode of the webinar series for emissions trading for policy practitioners, which is brought to you by ICAP, the International Carbon Action Partnership, with generous support from the European Commission. My own name is Benjamin Gerlach. I'm a senior fellow at the Ecologic Institute, which is one of the organizations implementing this. And I'll have the pleasure of taking you through the next 90 minutes of this webinar. Now, first, a few quick housekeeping remarks. The webinar is 90 minutes long, and we basically have three segments. We'll open up with a presentation from Constanze Haug at Adelphi, followed by comments from Anthony Cox and from Ira Dorband, who've currently joining us today, and I'll introduce them in a second. We then turn into a moderated discussion, to which you're very welcome to submit your questions. Please do post your questions using the question and answer functionality. You can make my life and our life easier if you indicate to whom you would want to address your question. And then, depending on how many questions we get and when we get them, I would channel these questions to the person that is addressed or that's most qualified to answer. And then just a quick remark, we will be seeing some presentations, and the colleagues, we will be putting them online after the session. So in a day or two, you will find the presentations then being shared online. And we are recording this webinar, and we will make the recording available on icap-training.eu. So then let us move towards the topic of the day, understanding and mitigating distributional effects of emissions trading. And we're very happy that we have three very distinguished experts to take us through some of the facets of this very broad and topical topic of today's discussion. We'll have an introductory remark from Constanze Haug, who is executive board member at Adelphi here in Berlin, and formerly the head of the ICAP Secretariat, the International Carbon Action Partnership, the organization under whose flag this activity is running. Constanze at Adelphi co-leads the carbon pricing program, and has been in the field for many, many years. Spent several years at the helm of the ICAP Secretariat, where she basically grew the organization into one of the kind of leading voices in international cooperation and sort of design capacity building issues around emissions trading. Before joining ICAP, she also spent several years at the Free University of Amsterdam, where she earned her PhD in environmental policy. We'll then have comments from Anthony Cox, who just very recently joined Ecologic Institute as a senior policy advisor, and before that spent 20 years at the OECD. Among other things, he was there the deputy environment director for a number of years, and in that function involved in several projects that were aimed at strengthening the climate, energy, environment dimension in international processes, including at the G7 and G20 level. Originally, Anthony is from Australia, where he also spent a decade working for the Australian Bureau of Agriculture and Resource Economics, and before that got his economics degree from the Australian National University. And then, last but not least, we're very happy to have with us Ira Dorband today, who is an analyst at the World Bank and also PhD candidate at the Mercator Research Institute on Global Commons and Climate Change, which is abbreviated MCC. Ira is an expert in the economics and the political economy of climate change policy, with a strong focus on distributional aspects, so especially on the issue that we're looking at today. So currently at the World Bank, she works as specialist for distribution and equity in the climate economics team, and is also, I think, still in the process of completing her PhD, which is looking specifically on distribution effects of mitigation policies in lower income countries, and has researched really sort of right and left from Vietnam to Nigeria and from Turkey to South Africa on sort of how to manage these transformations in a socially just and fair way, and to understand what the implications are. Now, so after that introduction, onto the topic of today. which is the distributional effects of carbon pricing and how they can be, what are they and how can they be mitigated. Now, at the outset, it's kind of an obvious point that carbon pricing works by changing prices, and that means at the end of the day, somebody will end up paying more. It will make certain products more expensive and other things relatively cheaper. But that means at the end of the day, somebody somewhere has to pay more for energy services than they used to in the past. And that's, of course, very sensitive politically because nobody is happy to pay more. And therefore has very sort of explosive potential, particularly if it comes on top of existing unfairness and existing inequalities. And we've seen that time and again in lots of countries around the world, most recently in Kazakhstan, which was, of course, not related to carbon pricing, but which showed the explosive potential of increasing energy prices. And so it's a strong reminder that carbon pricing, of course, needs to answer this question of public acceptability of such changes. But it's not only a matter of political perception and political popularity. It's also a matter of, is there something fundamentally unfair about carbon pricing, that carbon pricing affects different groups in different ways, and that it can work against objectives of sort of social fairness and inclusion. And the argument here is that of course, it affects different people in different ways, and some people may be, more in a better position to simply pay a little extra for the energy services, or they might have alternatives to avoid paying the additional cost because they can, for instance, they're homeowners and can insulate their homes and reduce their exposures, and others don't have that option. So the question there is, is there really something fundamentally unfair about carbon pricing? And if so, how can it be tackled? What other ways to sort of either within the carbon pricing system itself or by introducing flanking measures, supporting measures, how can these undesirable effects be controlled and mitigated? That's kind of in a nutshell the broad topic, and we're very happy to have the assembled experts to walk us through some of the facets of this topic today. But before we get to that point, we would like, in the spirit of these courses here, we would like to share or to hear your views, and so to get the question out to you, and to hear about your opinions on carbon pricing and inequality. And to do that, we have prepared a few Mentimeter questions that should be coming up in the chat in a second. So I just want to end the screen share and put the link in the chat. There it comes. And so if you head to Mentimeter by clicking on the link or by going to menti.com and then entering the code required, which is 88481002. And you see it there. You should be seeing some questions now. And so the first question we want to throw out to you is, we are experiencing right now fossil fuel prices behaving in a way that we haven't seen in a long time, or perhaps but never at all, certainly for the natural gas market. And so the question here is, in times of skyrocketing fossil fuel prices, should governments intervene by lowering carbon prices? I should say you have can choose up to 2 options if you have sort of, different views that aren't captured otherwise. So select which of these best represent your views. Is it necessary to intervene because governments should seek to avoid social hardships and political backlash, or is it necessary because you would say, well, if fossil fuels are expensive anyway, then we don't need to increase the price artificially, because at the end of the day, it's about making fossil fuels more expensive, and if the market does that for us, then policies don't have to, perhaps. Or would you say, no, carbon price should not be touched because that undermines political credibility and opens the door for all kinds of desires and demands? Or would you say perhaps another way to look at that would be, carbon price is a climate policy instrument, but if we're concerned about social issues, then we need social policies to address those. And trying to solve social problems through the carbon price isn't the best idea to begin with. So let's hear your takes. It's 18 people that I see have answered so far. So just tell us where you would come in on this question. And so far, as we see the dots flying in, there is very strong support for the notion that even in times of really high carbon prices, very high fossil fuel prices, we should not seek to tackle that via lowering carbon prices, because what it needs is social policy to solve social problems, and also, of course, not to invite any responses. And a few people, however, that also support the notion that to avoid social hardships and political backlash, we would have to work through carbon prices as well. Oh. And the first person to agree to the proposition that if the market does the price increasing, that policy doesn't have to do that anymore. Wonderful. So I think we can sort of close the first question and head over to the second one. Johnny, if you want to bring up the next one. And here the question to you is, now we will talk about the distribution effects of carbon pricing. The question is not so much, are there distribution effects or are there not? The question is, how do they compare to other policies? And so do you think that distribution effects of carbon prices are higher than other types of climate regulation? Are they about the same? Are they perhaps lower? Or is the problem really not not in the way that it's higher or lower, but is the problem perhaps more the visibility, the problem that we do see carbon pricing effects immediately, which we don't see as clearly for other types of policies. And we do have quite some support for that notion. Quite a few saying that irrespective of whether it's higher or lower, it's certainly an issue of visibility of the carbon price. But other than that, more support for the notion that they could be lower than for other types of climate regulation. Mm-hmm. Okay, now that seems to be an interesting pattern that's emerging. So more support for the notion that if anything, it could be lower, but certainly much more support for the idea that whatever they are much more visible, and that could be part of the problem here. Great. Then if we're not just move on to the third and last question, and here we would look at the question of how to compensate distribution effects. And we've listed here a few options that one could think of. The first one, a lump sum rebate to all households. Second one, lowering the price of energy for poor households, so making energy cheaper for poor households. Third one, helping poor households to reduce their energy use. So to assist them through whatever programs to lower energy use. And the fourth one, a targeted rebate for those with high energy consumption. So think of commuters, for instance. Or the fifth one, effective social welfare system. Again, in the spirit of, if there is an effective social welfare system, then these distributional effects are perhaps less of a worry. And we would ask you to select up to 3 of those and then give us your ranking on what you think is the most your most favorite option and your most preferred option to address these imbalances. And what we're starting to see here is a bit of a race at the top between the option of helping poor households to reduce their energy usage or addressing it through an effective social welfare system. And less support for targeted rebates to high energy consumers like commuters. And also interestingly, less support for the notion of the lump sum rebate to all households, which is, I think, the favorite option of many economists, because it is seen as least distortive and possibly easiest to pull off. Mm-hmm. Great. I think I would want to leave it at that and just use this as a sort of a big, quick feel of the temperature in the room on these issues. And we'll certainly hear more about some of these options in the presentations and can touch upon some of the questions in the ensuing discussion. But then at that point, I would want to hand over to Constanze to take us through, walk us through what are the distribution effects of carbon pricing, who is affected in what way, why is it a problem, and how can it be mitigated or compensated. So floor is yours, Constanze.
1 second. Very pleased to be here. I've just the first few clicks to make sure that you actually see my presentation in the way that you should. Thank you very much, Benny, for a fantastic introduction and scene setting, both in terms of, I think, very pertinent questions that will be fun to get back to during our presentations and the discussion, and also the way you framed the salience of this topic. So I don't think I need to say much more about this. Here are some pictures of protests from around the world over the last year around rising fuel prices, mostly. And in France, we have the yellow vests that very specifically protested initially against the increase of the CO2 tax in France. So for the longevity and sustainability of carbon pricing, thinking and understanding distributive impacts, effectively dealing with them, but also properly communicating them is key. So this is, I think, the premise around which this webinar is based. You've already also said, Benny, what I'm going to do in my presentation, which groups are affected from carbon pricing, put forward the notion that revenue recycling, so returning revenue, is a key strategy for addressing and improving distributional outcomes from carbon pricing, and address a couple of options, how this can be done, and finally move to some concluding remarks. So in a way, this is really very much a scene-setting presentation, I think, for also the remarks from Anthony and Ira that come after. So looking forward to the exchange here. So what groups do we have that are affected from carbon pricing? We have carbon prices increase the cost of energy. So they obviously have an impact on regulated entities, carbon leakage in terms of competitiveness. But I think what we are here more interested in are the effects on the other groups, primarily households, which have to pay more for energy and fossil-intensive products. But there's also some other interesting aspects here, I think. There will be regions and sectors that are particularly impacted by carbon pricing, and that will require very careful planning for this overused buzz term of a just transition. And there's also an aspect here of co-benefits, because carbon pricing means geographic flexibility, particularly emissions trading on where emissions are reduced, cleaner air in some parts that others are not enjoying. So a fair distribution of co-benefits of carbon pricing is also part of this picture of distributive effects in a broad sense. So what are then the ETS effects on households? We have the regulated entities that face the direct carbon cost from an emissions trading system and then pass it on to consumers, which in turn yields to rising prices for energy and, depending on what is covered, fuel. And here we come to two key notions, two key terms in the debate around distributional impacts, which is progressive versus regressive, which I think Ira and Anthony will certainly come back to. Would just like to be very clear on this. This refers to the effect of higher prices in proportion to income. So if poorer households pay proportionally less than wealthier ones, it is a progressive policy that helps just outcomes or socially just outcomes. In turn, it is regressive, where poorer households pay proportionately more than wealthier ones. And then here, a first hypothesis or first preliminary finding from a lot of the academic literature around carbon pricing is that while carbon pricing in industrialized countries in the first instance tends to be regressive, so disproportionately hit the poor harder, it is generally, or there's much more potential for it to be progressive in emerging economies and developing countries. And we'll get to the reasons of this in a second. This is not to say, however, that distributive impacts are not an issue in developing economies, because we have big challenges around energy access and affordability also in this part of the world. And here we have the first part of an explanation on how these distributional outcomes that I just talked about come to be. This is a very typical graphic when thinking about distribution that you'll come across in the literature over and over, which splits up the population in income deciles on the x-axis. And here we have on the y-axis the carbon footprint. And you will see that poor households, so at the left of the x-axis, have a much lower carbon footprint. This here is for the UK. Compared to the highest income households. In this case, this is about 3 times as much, if I'm not mistaken. And you see this also for different consumption categories, transport having the biggest increase. And this type of curve is even much more pronounced in the global south, where the poor have a many times smaller carbon footprint than the rich, primarily relating to transport, but also to other aspects, which also then is already part of the explanation why carbon pricing can be more progressive here, because the rich will face much higher carbon prices, also relative to their income, because of their much higher carbon consumption. But as I said, this does not mean that very carefully thinking and assessing distributive impacts is not an issue for the global south, because we still need to consider the development impacts of carbon pricing, which I hope Ira will also shed more light on. Here, just 2 examples. When we increase prices for fossil fuels, there may be a risk that this prompts a switch back to cooking with biomass in some parts of the developing world, with attendant very negative health impacts and nothing won for the climate. And there's also, this is a study from Uganda, which assessed the potential impact of a carbon price on food baskets. And we see here in this modeling that this actually leads to less nutritional diets for the poorest. Important to say here is in the study there was no revenue recycling, so no giving back of the revenue to the population. Also important when we talk about distributional effects is what is called horizontal and vertical inequalities. Different regions can be affected differently by carbon pricing. This is to do with, for instance, the electricity mix, or also higher and lower temperatures, which may require more or less heating. Here's a case of Mexico. This is really to do with the electricity mix in this case. And also urban and rural populations are affected differently. This is to do with bigger spaces that need to be heated, with more exposed walls in the countryside, and also modes of transport, longer distances, less availability of public transport. So these are definitely relevant effects that, in addition to income groups, so vertical distributional impacts, there are also these horizontal spaced out distributional impacts of carbon pricing that we should not forget and look at when we design policy. Moving on then from what are the impacts to revenue recycling, returning some of the revenues from carbon pricing as a central strategy for improving social outcomes from carbon pricing. And here again, we are in this 10 income decile graphic. This is an example from Germany, modeling of the, at this time still prospective, German carbon price and the impact on different population groups. And the importance here is the difference between the red bar. What would happen? What would be the impact of a policy? In this case, I think it was 120 euro CO2 price on different income groups without returning any revenue. That's the red bar. And here we have 4 different ways of giving back this money in different modes. And the clear result here you have for the lowest income group, no matter what type of redistribution option is chosen in this modeling, the poorest are better off in terms of disposable income than they are without the policy. So there is real potential here through smart policy design actually to improve social outcomes. An important caveat here underneath is that we should not forget that when we talk about redistributing revenues from carbon pricing, we need to have that money in the first place. And for an ETS, if we distribute all allowances for free to industry, we will not have such revenue. We need to auction allowances, so to sell allowances to regulated entities in order to have that income and in order to be able to spend it on other purposes. For a carbon tax, that is more natural. There is always the treasurer that collects money, and if there's a possibility to earmark, can spend it. ETS revenues have increased quite significantly in many different parts of the world. Here you see some statistics from ICAP from last year. The EU ETS is the biggest market, of course, also, but has faced big allowance price increases. Cumulative revenue now, as of last year, stands at 80 billion euros, much more than this year, given the steep price increases. But I think the other part here is also relevant. As I said, we need some auctioning. And you see there's very different approaches here among the more mature ETS, whereas REGI, a system in the Northeast, has almost always almost completely auctioned of its allowances. We have slowly rising shares in Korea and the rest in the middle, distributing between 40 to close to 80% of their allowances through auctioning. So when we think about what we should spend carbon revenues on, there's different considerations here that come into play. Are they, if our most important concern is improving social outcomes, effective at redistributing the costs of the policy away from low-income households? And I think that is also what was reflected in the survey results a second ago. We want to make sure that the poor are not disproportionately or particularly hard hit. But I think another important aspect here is, are they preserving the carbon price incentives? Because we are pricing carbon in order to reduce emissions, and that primary incentive of the policy should remain as intact as possible. Another important side consideration is, are they improving the availability of other low carbon substitute? Is there actually a way so that I can change my behavior towards more environmentally friendly outcomes? Or am I just stuck paying more because there is no bus that is running from my house? Finally, another side consideration, carbon pricing could help from taxing the bad to taxing the good, taxing the goods to taxing the bad. So if we change the tax system, this could make the tax system more efficient. And last but not least is a really important practical consideration. What about transaction costs? Can we actually administer this system, and how costly is that to return the revenues? And this is where lump sum, as Benny said, a beloved option by economists, tend to fare less well, or where there is kind of more doubts how practicable that is in some economies. Very quickly running through these options, but I also don't want to take too much time here so as to leave enough for the other speakers and discussions. Lump sum payments, as I said, are strongly progressive because a return of 100 euros a year to a poor household has a much bigger effect on that household's disposable income than on wealthier households. If well communicated, it can be very visible. There have been different attempts, for instance, in Switzerland, in California, sending explicit letters. Here is a clear rebate on your electricity bill thanks to carbon pricing. But it's challenging to make people aware that they are money back. And I think it's also important to say that this really reinforces this perception of the atmosphere as a global public good. We are all doing our part in polluting it, but if we are polluting comparatively less, this actually helps. If we're polluting relatively less, then also the policy is less costly to us. But as I said, transaction costs are an issue. Can a government really reach all households and make those transfers in an efficient manner? And also I talked about improving climate outcomes through revenue spending before. There's no double climate dividend from this. This just goes to the income, to the household income. Switzerland is the key example here, which returns the revenue from the CO2 tax through its health insurance system. Another option, as I said before, is lowering other taxes, increasing the efficiency of the overall system. I think Anthony will talk about British Columbia, if I understood correctly. That's the key example here, where British Columbia introduced a carbon tax and at the same time reduced both, I think, income and corporate tax, but focused this on a tax credit for low-income households. And I think that is very important to say. You need to focus on this low-income segment of the population in order for this redistribution option to be progressive, because otherwise the rich are paying more tax. You need to address that aspect specifically. Sweden is the other prominent example here, which is the first one to introduce a carbon tax a long time ago and has always done this in a balance, reducing income tax and increasing carbon taxes. Finally, we have the big and diverse field of subsidies and transfers. This is using the existing social welfare system to shield the poor from the consequences can be a relatively practical way of improving the social outcomes of carbon pricing, for instance, increasing housing subsidies, as is done in Germany. California has also put a focus on this. But as I write in the minus column, this only also reaches only the transfer recipients, so has specific groups that are targeted through these options. And particularly for subsidies, for instance, for clean mobility or energy, these need to be means tested to be progressive. I mean, otherwise the e-vehicle rebate will not reach the poorer brackets of the population. Reducing the cost of electricity is also one option to spend carbon revenues on. Again, this is part of the redistribution package in several countries, including Germany, where the renewable energy surcharge is lowered with the income from carbon pricing. On the pro side, this helps electrification and sector coupling if energy becomes cheaper. The question how big the rebounds effect from this are, I think, is hotly debated, but this is at least one theoretical argument against. In a quick summary, there is different ways of giving back income. I think many countries are actually going with a mix, because as you have a mix of policy objectives, you may also consider using a mix of redistribution options. I think a key challenge is communication around this then, because the more dispersed the approach to compensation, the harder to say, this is what we did with the money we got from you from carbon pricing. And the picture would also not be complete without emphasizing that spending revenue is one part of the equation, but there is a really important role that complementary policies play in the climate policy mix to drive down the cost of other low carbon options and actually make it possible for people to not just pay more, but change their behavior. And I think there's aspects here within climate policy and also what I said more broadly, social policies, just transition policies that really have an important role to play. So what would I conclude? I think we can say, after, if we include Sweden, 40 years of carbon pricing, that we have best practice that shows that it is possible for carbon pricing to maintain public support, but only if there's careful thought and policy design about distributive outcomes and how to mitigate these, and effective communication around this. And if I look at, being German myself, if I look at Germany over the last 2-3 years, I'm still disappointed how few people know what carbon revenues are being spent on, and how also from my perspective, little effort is made in telling the population what this money has been used to. Social impacts are more visible and more direct when covering some sectors compared to others. I think particularly transport comes to mind here. And I also really liked Benny's introductory question in, yes, we should all be aware and also keep emphasizing that all climate policies has to have distributive outcomes. It's only on carbon pricing where the dollar or the euro sign is particularly visible, and the backlash, therefore, also much more likely. I hope to have shown in my presentation that visible recycling of revenues can really effectively address adverse social impacts, or hopefully even improve social outcomes overall. However, this requires funds to spend, so ETS auctioning. And as I also explained, there is a trade-off between different policy objectives here, between furthering the climate impact of a policy versus really putting social concerns center stage. Last but not least, complementary policies are also a really important part of the picture when discussing on this topic. Thank you so much. I hope I stuck within my allotted 20 minutes. Wonderfully on time. Many thanks, Constanze, for taking us through some of the many intricacies of the topic in a very clear and skillful way. And then let's sort of we've noticed with pleasure that there's many questions and comments already shooting in, and so keep them coming as well. I'm sort of having an eye on that, and then we'll sort of channel them as we go into the discussion in a moment. But before that, let's give the floor then to our discussants to respond to Constanze's point. And first, I would want to invite Anthony to share some of his views. Having spent 20 years at the OECD, that is of course very much also involved in trying to identify and bring solutions to its member countries and beyond. That also include, of course, questions of of carbon pricing and how to make it socially more acceptable. But I guess having worked at the coal phase, if you excuse the fossil pun here, having worked at the coal phase of making that happen, you also understand a thing or two about the difficulties in getting these solutions that Constanze presented to getting them implemented, getting them taken up, and possibly, of course, in your own country as well, there's a story to share. So I was wondering if you could share some insights, some lessons learned, and sort of what makes it possible to bring about these social flanking measures and these compensation systems that Constanze has introduced to us, and why is it so difficult sometimes in practice to get them implemented?
Well, thanks a lot, Benjamin, and good afternoon or hello to everyone online, and thanks a lot to the organisers for the invitation to participate in this workshop, and a huge thanks to Constanze for the very stimulating presentation, which covered the ground very well, and but also raised lots of interesting points that I think it's worth delving into. And I'd like to pick up on a few of these points and expand on them a little, and also like to, as requested, Benjamin, to add some thoughts on the political dimensions of carbon taxing and how these impacts on the distributional question. So I'd just like to start up by raising a few more points about the recycling issue. As Constanze very rightly pointed out, this is the key issue. Whether the distributional effects are going to be neutral or progressive or regressive. And compensating households is certainly key. Compensating poor households is the target in terms of social inclusion. But there's a range of ways in which we can help do that. One of which is, when you do recycle the revenue, you can help reduce other distorting taxes in the economy, such as taxes on income and labour. And this is shown through some work that was done at the OECD to result in higher employment, in GDP growth, in increases in individual welfare. The other way that is often used to recycle revenue is to undertake public investments in infrastructure. The big differences here are that one is visible. Public investments in infrastructure are very visible, easy to put a label on those, easy to attribute the investments to the revenue, to the carbon tax. Whereas reducing taxes, putting income back into the hands of households is often a lot less visible. It's easily absorbed into everyday behavioural responses on the parts of households and individuals. So it can be a lot harder to generate the kind of political acceptance and the social acceptability. One of the things that is also quite important in this recycling issue, and when talking about the distributional impacts between households, is that not all energy taxes are the same. We have taxes on electricity, taxes on transport fuels, taxes on heating fuels. Now, taxes on electricity and on heating fuels tend to be quite regressive, whereas taxes on transport fuels tend to be much more progressive. So there's some scope there for having a more nuanced and differentiated approach to how you think about the compensation packages that you might offer up to the society. One of the things that Constanze touched on, but I think is worth thinking about a little more, is this distinction between uniform and targeted cash transfers. One of the easy things for governments to do is to just give everyone a check. That's nice and handy. It's a lot, but the evidence shows that a non-uniform targeted support to households is actually much more effective in achieving social goals, in achieving good economic outcomes, and in achieving strong environmental outcomes as well. So I think that's one of the areas where more work needs to be done to think about how these are implemented in terms of the different types of fuels that we are looking at. Benjamin, you quite rightly pointed out that I'm Australian, so I do have some experience with the Australian experiment on carbon pricing. And I think there are some interesting lessons there in terms of the political challenges. Just for those who might not be that aware of it, that in 2012, Australia introduced a carbon price. It focused on recycling the revenue. In fact, it focused on overcompensating. It more than recycled the revenue. It dipped into general revenue to make sure that this was as politically acceptable as possible. The impact was very positive. Incomes were held up, increased, growth was okay, emissions went down by 7% in a year, but then the wheels fell off. I think there was a climate skeptic prime minister came into power, who effectively white-handed the tax and created a lot of uncertainty in the minds of those who were investing in clean energy and in energy efficiency through exaggerated claims, through basically labeling it as a tax without emphasizing what the positive sides are. One of the things that, there are several lessons that just quickly we took from, or we can take from that. One is that there was very poor communication around trying to link the improvement in economic prospects for the community to the carbon tax. It was too easily labelled as a tax, even though the government called it a price. There was pretty poor delivery of the compensation, and in fact, a number of the government members who introduced the carbon pricing scheme said they would much rather have just given out a check, as they do in the California case, than do it through the tax system. And the third thing is that in terms of the politics, we found there were carbon-dependent economic interests had gained a very persistent voice in policymaking on both the right through business and on the left through industry unions. So this created a kind of a double representation of carbon polluting interests in the policy making process, and so that made it very hard to fight. I've just got a few more minutes. I'll just pick up on some of the lessons that we've learned from the work that we did at the OECD on fossil fuel subsidies reform, and link those to some of the real world challenges that we see. One is that the packaging matters a lot. And we've touched on this a few times, whether it's a uniform or non-uniform cash transfer or a tax reduction, whether you just give them a check or whether you give it in investment. Using the social security system in some countries is going to be a much more effective way to do this than through the tax system. I think that's particularly the case in many emerging economies. The second point here is the timing of introduction of these kind of reforms is key. Making it sequential to other broader reforms, linking it to structural reform efforts in the broader economy can make these much more palatable and can make it part of a bigger picture, provide a more holistic vision of what the economic direction of a country might be. The geographical distribution is key. All politics is local. And Constanze mentioned the vertical distribution effects, so that the differences between regions, and this is particularly important in countries like Australia, where you have strong coal mining regions, which effectively held the balance of power for the whole government in North Queensland and in parts of Victoria and New South Wales. The other dimension is that the behavioural responses of firms and households are key. It is not necessarily obvious how households will use the money that they get from their compensation, and it may actually be used in perverse ways. And we've seen examples of these kind of subsidy reforms lead to perverse outcomes with things like in other areas like the Cash for Clunkers programs in the United States. And finally, I would just emphasize that underpinning all these reform efforts, you really do need to have a stable business environment, a stable environment where you have strong institutional and administrative capacity, where you are investing in infrastructure and labour productivity, that you enhance the information flows throughout the economy and link it to emerging trends such as technology change, which will have an impact on the way in which these kinds of changes are able to be implemented. If I'm correct, that's my 10 minutes. I would love to go on more, Benjamin, but I'll leave it there and look forward to the discussion.
Indeed, and we'll give you more time then when we come to that, but of course also then responding to some of the questions we're getting from the audience, which are really flowing in nicely. But many thanks, Anthony, for walking us through some of the insights from 20 years of OECD work and plus the Australian experiences. And now, before we get to the open discussion, last and certainly least, we'd invite Ira to also share a few views, and I think it connects nicely to some of the points that were made by the previous speakers on trying to also sort of broaden the scope a little bit and take the sort of bigger picture interview. We talked a lot about how carbon pricing, by making certain goods more expensive, affects the consumption side of things, but you've also looked at sort of how carbon pricing works its way through the economy and also has sort of other repercussions that Anthony also alluded to in making the changing some of the economic structures and in that way creating benefits and co-benefits in different parts of the economy. So I'd invite you to take us through some of these effects and what you found out there.
Thank you so much, Benjamin, and many thanks to ICAP and the organizers for inviting me to speak. And thanks also, of course, to Constanze and Anthony for their already very comprehensive overview and very important points that have been raised. And thanks to all the participants as well. So let me share my screen.
It's coming up now and looking good.
Enlarging this thing.
Wonderful.
All right. Great. So yeah, as Benjamin already said, I would like to open the topic a little bit and look at carbon taxes, let's say, more from the point of view of fiscal policies in general. And there I would really like to emphasize that carbon taxes can very well serve, or even maybe better than other taxes serve, to achieve some of the more, let's say, traditional and domestic policy goals of tax policy in general. So let's see if I can, That's carbon taxes can support inclusive development very broadly. And on the one hand, that is because what we've discussed, carbon taxes raise the price of fossil fuels. That reduces the consumption of fossil fuels in the economy, which entails large health and environmental co-benefits, but then also it incentivizes low carbon structural change, which again affects the economy through sectoral shifts, employment changes to the informal sector, potentially depending on how revenues are being used. And that said, carbon taxes also raise revenues and can be seizable revenues, which can be used again for other tax cuts or public spending, public investment. And Anthony has already discussed and as well Constanze some of these options. However, this, let's say, broader view alludes to the fact that maybe distributional effects might be actually broader than just, let's say, the consumption or side of things, the consumption and revenue use, and go into other topics as well. So how we think of carbon taxes is we use a little bit of a broader framework to understand which economic channels might determine the incidence of carbon taxes on households. And now this is a complex picture. I usually it's been building up, but so I won't go into the details. Just very briefly, we've said that carbon taxes change consumer prices. They induce low carbon structural change, which entails employment and skills effects, income effects. Revenues are being used that can be revenues are being raised that can be used for various things, and environmental and health co-benefits can be seizable and so positive and also progressively distributed. Since we've spoken about consumption and revenue use, I would like to focus on the employment and income effects and on the health co-benefits and present some evidence on these two aspects. So first of all, regarding the overall employment effect of carbon taxes, there is increasing evidence that those can be beneficial on the economy-wide level. So on the left-hand side, the graphs show that show estimates of based on Central and Eastern European countries between 1993 and 2020. And those graphs suggest that actually compared to personal income taxes, environmental taxes, raising revenues with environmental taxes can have more beneficial employment effects as compared to personal income taxes. And on the right-hand side, Makanya et al. Look at the overall job creation from low-carbon transitions in the energy, electricity and gas sector. So, of course, that includes sectoral and also cross-border spillovers. And they also find that between 2000 and actually, I can't see it, but you can see that I think it is 2016 or something like that, that entailed quite large positive employment effects relative to the business as usual baseline. Now, of course, the question is how might those employment effects be distributed across income groups and also across countries potentially? And there's some evidence that also these employment effects might be, depending on the policy design, equity enhancing. So on the left-hand side, the European Commission estimates that lower wage jobs will increase more than middle and high wage jobs under the decarbonization scenario relative to the baseline that is until 2030 here in this graph. And then some of our own modeling for Bulgaria, for example, suggests quite similar outcomes. So we're modeling here a $55 tax, which is revenue neutral. That means that all the revenues collected are used to cut low-skilled labor taxes. and that might also increase employment overall, and it might actually be progressively distributed. That is, that jobs that are held by lower income deciles see higher increases in demand. That, of course, translates also through various channels to income. And there is, it's mostly modeling evidence, but there is increasing evidence that also income effects from carbon pricing can be large and progressive. So this shows results from Golda and Hafstead from the Resources for the Future. This is for the US. And we see in the blue section of the bars, we see that actually income effects, albeit mostly negative, however, they affect mostly the high income deciles. And the intuition behind that is that carbon pricing affects carbon intensive sectors more, of course, and carbon intensive sectors are more capital intensive. And so with carbon pricing, the economy will turn more to labor intensive sectors, and thereby the returns to labor change differently than the returns to capital. And because high income households hold or get a larger share of their income from capital returns than from labor returns, that strongly affects the progressivity of that effect. Now, last but not least, there's also seizable health co-benefits. And those might or might not, there's even scarcer evidence on that, but also be progressively distributed. So on the left-hand side, we are modeling health co-benefits from a $80 carbon tax, and one can see to what extent that would avert deaths relative to baseline air pollution deaths, and then relative to the total population. And for example, in India, we can see India is a large country, so we can see that up to 40,000 deaths annually could actually be averted by such a tax, because again, the tax reduces fossil fuel consumption and makes households and industry switch to cleaner sources of energy, and thereby also air pollution. Ambient air pollution is being reduced. And those in India, for example, those 40,000 averted deaths are actually more than 2% of overall air pollution related deaths. Now, in some countries, that share of overall air pollution deaths is actually much larger. So, for example, in Russia, we estimate that it might even reduce the air pollution-related deaths by around 10 to 12%, and the same is true for China. And then on the right-hand side, this is very preliminary evidence, but we model the exposure to baseline air pollution, so that is not air pollution co-benefits from carbon taxes, but just looking at air pollution as it is, in outdoors, so not considering indoors, in Mexico across income quintiles, and the regressive distribution of the baseline in rural areas might actually suggest that the co-benefits of a carbon tax will then be progressively distributed. And of course, one needs to bear in mind that apart from the total exposure to air pollution, poorer income households are also much more vulnerable to the same levels of air pollution. So their health effects will be much larger and more negative potentially. So overall, what that means is that distribution might be even more progressive than thought. And this is just an example for Romania to illustrate what that would look like. So on the bottom, so the negative effect is the consumption effect. And we can see that it's smaller than 2% and neutrally distributed. But then if all of the other effects are layered on top, we can see that actually that might be a much larger effect on overall, well, as a share of disposable income. So here we are estimating health expenditure savings due to the air pollution reduction, and we're using the revenues as transfers to spend on information and communication technology. And bear in mind that this does not even show the income effects, which might be even more progressive. So in conclusion, distributional and equity effects of carbon pricing reforms need to be considered ideally very comprehensively. That might be beyond consumption, since those then tend to be larger and more progressive when accounting for changes in employment and income, and also for benefits. However, it's very important, and that's been emphasized as well, effects will be heterogeneous across countries and depending on tax policy design. And so there's definitely a need to for informed government intervention to buffer any potential negative effects. And that speaks to the need for ex-ante policy advisory and tools to understand beforehand what will be the effects. And here I would like to briefly well, just point to a joint tool that we are developing with World Bank colleagues and IMF together. So it's undecided whether it will be the carbon pricing assessment tool or the climate policy assessment tool. In any case, it's very focused on carbon pricing, and it's an Excel-based tool. It's ready to use for most countries around the globe. It allows the user to model very tailored carbon pricing policies across carbon tax trajectories and sectors, etc. And it informs various metrics of relevant interests, so macroeconomic GDP effects, development and health co-benefits, including air pollution, averted deaths, and then also on the distributional incidents. We model various aspects, mostly on the consumption side though, and on the revenue use side. And this tool will be made public very soon. So hopefully you will be in the next months be able to just download that Excel tool. It's very large though. And then there's a second model that's still under development, where that should ideally will in the future inform the sectoral employment and competitiveness effects. And I will not go into the details for now, but just that is also, we're working on that, and should also in the next year at least be made publicly available for tailored analysis. Thanks. That's it from my side. Thank you.
Wonderful. Thank you very, very much, Ira, and also for the outlook on the tool that's coming up. That's looking really interesting. Just for the benefit of the sort of the non-German audience, we in Germany had a very intense discussion on social effects of carbon pricing in the course of the last year's election campaign, and MCC, where Ira is doing her PhD, was one of the a good voice to have in terms of bringing some facts into this debate that otherwise has a tendency of getting sort of hijacked and taken into a different direction. So good to see that there's sort of tools coming up for also fulfilling that function in other countries and other discussions. Now I would then go into the question, and we fortunately have many questions that have come up in the Q&A already, and I would sort of dive right in with some of those that have come up and relay them onto our speakers, starting with Constanze. In particular, there were questions around these different compensation options that you showed us, and one of them was the question on the lump sum rebates that would be a good tool, and economists love the idea, but in practice it doesn't really happen a lot. And if you could elaborate a little bit more on what are the hurdles, what's the political issues or the practical issues that keep that from being implemented. And the second related question was on the different compensation options, how they perform in terms of preserving an abatement incentive or stifling the abatement incentive. If you could elaborate a little bit on that one, that would be much appreciated. So we'll start with sort of a combination of those two questions and then move on to others.
Sounds good. Many thanks, Benny. Yes, lump sums is a really interesting one, and I think there are obstacles or challenges on two counts, actually. The first one, as I discussed a little bit, is the purely practical. Do we actually have channels and information available for each and every person / households on bank account data? On is there systems where we can make those cash transfers, be it through checks in the US, but we are no longer really using checks, at least in Germany, or by means of bank transfers? And how feasible and how possible is that? At least in Germany, the discussion is this would be very complex. The second interesting part, I really think is and Anthony alluded to that, is the popularity. Is this really an option that resonates with the public and that helps the popularity of carbon pricing? As mentioned before, economists love this, very logical. Poor people have a relatively larger positive impact from that than wealthier groups. At the same time, when this is tested in focus groups, the result is often this is not a popular result, because the fact that it is fair if you also give the rich people money back does not resonate in these focus group public opinion survey. It's very often the focus is green spending. Well, this is a carbon tax, so let's rather amplify the effect by spending on additional mitigation. So a little bit in a nutshell, my thoughts, or what I would take out of the debate around lump sums. But I think really others will have interesting aspects to contribute here. Preserving the abatement incentives. I mean, I think here the green spending options are clearly the ones that rank highest. And I think the first one here is subsidizing public investment. This could be public transport. I think it is a really important one in this regard, or subsidizing private investments, such as I said, clean vehicle rebates, housing insulation, aspects like that. But yeah, so this there we need to be very careful to make sure that this targets broader groups than just the wealthier income deciles. So much in a nutshell.
Excellent, many thanks. And I think that the last point also alluded to one of the other questions that was raised in the through the Q&A on making inelastic goods more elastic, which I think is sort of an economicsy way of asking, you know, isn't it better to give people options to respond to the carbon price rather than just slapping the carbon price on them, and sort of how can we think more along those lines? But that you know, there also we certainly appreciate more views from the panelists. But first, let me sort of pick on another question that was brought up, and which I think directly relates to research that Constanze referred to, but that actually goes back to Ira and her colleagues at MCC. This was this observation that carbon pricing tends to be more progressive in emerging economies, and whether it's really more progressive at all or just less regressive than in developed countries. So Ira, if you could dwell on that point, and perhaps while we're still in the area of sort of data questions, there was another comment or a question from Nick from Switzerland about how the regressiveness or the effects play out across different sectors. That, you know, in transport and in housing, these things may differ because people have different alternatives available or not available to them when it comes to pricing in transport, in housing, and electricity. So if you could sort of allude to those two questions, that would be excellent.
Thank you so much. Yes, those are very important questions, and I will answer them now because I think that's how they are meant from the consumption side of the medal. So yes, there's strong evidence that in lower income countries, carbon taxes, the consumption incidence of carbon taxes may be more likely to be neutral or even progressively distributed. And that has simply to do with the fact that fossil fuel consumption items, or in general carbon intensive consumption, is more of a luxury consumption, or it involves the luxury consumption basket than the, let's say, normal good, which would be distributed in a way that also lower income households are using it. So that, for example, higher income households may have a car, while low income households are nowhere near being able to afford a private vehicle and so forth. And however, there, of course, in lower income countries, there's also the distributional effect might not be the most important issue, but actually the absolute effect on the poor, irrespective of the overall distribution or the, let's say, the vertical distribution, the effect on the poor may actually be more important. And I would like to emphasize that there's really a few ways to buffer this. And I was quite surprised in the, I think it was the second question in the questionnaire in the very beginning, in the participants survey, where rebates didn't fare that well. And I would like to emphasize that there's a few countries, including in India, for example, who have very effectively used rebates. And the way that that works is that, for example, one aspect of carbon pricing is that, of course, it increases also the price of fossil cooking fuels. Now, one will, and rightly so, probably guess that if fossil fuels for cooking increase their price, then more and more households will switch backwards to biomass-based cooking, which of course we do not want, also with respect to indoor air pollution and health effects. So one option is to provide the minimum of fossil-based cooking fuel to the household. So for example, in India, LPG is mostly used for cooking. So the government paid for 1 cylinder of LPG for the countries, for the households per week, and to make sure that they can still cook. So, and that actually, there's other options which allude a little bit more to what Nick has raised, to let's say, unlock elasticity. So, for example, if revenues are used to build up the electricity access so that actually more households are connected to the grid, then it is possible for them to switch their consumption more easily to less polluting forms of energy. So let's say from cooking with fossil fuels directly, they will now cook on electric cook stoves, just as, you know, in Germany was done 50 years ago. And yeah, and maybe also on the cash transfers in lower income countries, the way that that can work is through e-wallets. And there are some very effective and quite efficient programs being rolled out. For example, in Nigeria, there's an e-wallet scheme for farmers to support them with fertilizer subsidies. And there's more and more, let's say, in Kenya, there's e-pesos. So there's a lot of these digital currency schemes that can be increasingly used to support households, depending on how these sectors, you know, now answering Nick's question, depending on what drives the negative distributional effect in a country, that can be quite heterogeneous actually across countries.
Excellent. Many thanks, Ira. Then over to Anthony to play 2 questions your way. The first one, perhaps if you want to come in on that question that we briefly touched upon as well, on making the inelastic goods more elastic, and sort of what can carbon pricing change to open up new abatement options, make more abatement options available, and if you could sort of think of good examples for how that could be done in practice. And then there was another question specifically related to the Australian example that, as you mentioned, did overall sort of benefit large parts of the population, and perhaps even, as you mentioned, overcompensated some of the effects. And wasn't there a backlash when that was taken away by the people? Sort of, if it was a sort of a net beneficial program, then that might have led to some unhappiness as well on the side of the voters. If you could sort of refer to these 2 questions.
Thanks. Good questions. I just on just the first one around making the inelastic elastic. I think it goes to the heart of the policy design question. One of the traps that we sometimes fall into as policy analysts or as economists is to just think in a silo. We just kind of have a carbon tax, we're going to revenue, we're going to recycle the revenues. In fact, it's a policy package, and you can actually more effectively design a package that combines cash transfers, targeted cash transfers, rebates, and investments in innovations that help to drive more effective energy efficiency options and uptake in lower income households. And this has been used very successfully in some countries. I think India was pointed to there, but also in some African countries, and also in Indonesia, if I remember correctly, particularly in relation to fossil fuel subsidy reform. When they introduced those reforms, they combine that with some investments in new technologies, trying to drive it into the developing, into the poorer households. So I think it's that package approach, and the policy design becomes key. In relation to the Australian example, one of the interesting things was that the incoming government that scrapped the carbon pricing scheme didn't get rid of all the compensation that was flowing to the households. It just assumed a lot of that debt. And so that had a macroeconomic impact, which then flowed on throughout the rest of that government's term. So it was a bit of a mess, to put it mildly. So they didn't face the backlash in terms of the lost compensation from consumers.
Excellent. Many thanks, Anthony. There was one other question that I would pick that I would channel to Constanze, perhaps, on since it goes sort of also to the mechanics of emissions trading systems, and this is about free allocation of permits, and the question, does this actually have an effect on the income effect? We talked more on the size of the effect of carbon pricing increasing energy prices, and that way creating some distribution effects, but the question would be if the free allocation also in itself has an income or a distributive dimension. So Constanze, or perhaps also Ira, I'm not sure, but if you want to sort of comment on that question.
I can certainly start, and it's interesting because it brings in another really important dimension to this debate, right? Because we've talked about vertical between different income levels, we've talked about horizontal in terms of spatial terms, but we've not talked about regulated entities, so the companies directly regulated by emissions trading, private sector versus citizens. And here is where the key distributional impact of free allocation comes, because if we are giving permits to companies for free, who then pass on the carbon price nonetheless to consumers, it's clear that citizens are paying the cost, and the private companies that are regulated to a much lesser extent. And I think this again you also have in the revenue recycling options, reducing the cost of electricity. Again, using the German example, applies to industry and citizens alike. So it is a redistribution option that goes across the board and doesn't target primarily the end consumer, so to say. Just very briefly, but I think others can add aspects here.
So I'm letting Ira decide if she also wants to weigh in, but there was sort of another question that also I would channel towards Ira that came from Mike Jacob on the sort of, if you look at the deciles, that is one way, of course, of understanding who is affected, but then within these deciles, you also will find that there are some people that are more or less affected depending on their specific situation of life, where they live, how they live, what buildings they live in, etc. And you alluded to some of that granularity in the examples that you showed, that also matters. But how far can you go in towards identifying these people and sort of then assisting systems that of course becomes ever more complex and tricky to administer as well, to seek out these people and compensate them? So if you want to allude to that, and if you want also the allocation question.
Thank you so much. Yeah, that latter one is a very difficult one, of course. First, I would like to briefly discuss or just add to what Constanze said on the incidence that is kind of being passed on to the end consumer. And there actually we have increasing evidence, and also that includes empirical evidence, that the increased prices, either due to ETS or carbon taxes, are much less than 100% passed on to the end consumer. And what I showed on the incidence on capital versus labor, that's part of that. So actually some of the price increases are being internalized and borne by, for example, profits. And some price increases so upstream price increases of fossil fuel prices are actually not even passed on directly to the end consumer. So there's some evidence that in lower income neighborhoods, the increases in energy prices are much less from a carbon tax than in higher income neighborhoods, for example. So that makes even the consumption effect that is empirically seen a little bit more progressive and smaller overall. Regarding the horizontal effects and the large heterogeneity of incidents and effects on households that Mike asked, of course, that is one of the key questions, and it's very difficult. And I believe that there's no one-size-fits-all answer across countries. So what we try to do also with this tool that I showed is that we really understand or try to understand for each country and each carbon tax reform, which is very important because a carbon tax, let's say, putting a carbon tax of $50 across the economy as a whole will have very different effects on different fuel prices. So if coal is previously subsidized, for example, the price increase of coal will be much larger than the price increase of petrol or something like this. So first of all, that needs to be looked at. And then for a certain country, one really needs to understand who's who and who consumes what. And then either the existing lifelines of governments can be used to alleviate the pressure on certain citizens, or, as I said, new and also, let's say, technologically more innovative schemes can be used. And that really depends on the country's, let's say, culture of social assistance, and that differs a lot between continents and between countries, and there it's really a question of what works in a certain jurisdiction.
Many thanks, Ira. And mindful of the time, we sort of almost get to the close, but can have sort of a last quick question, which I would sort of pick up, or last two questions from one question I would like to pick up from Elvin from Singapore. Hi, Elvin, good to see you again. Who was one of the participants in one of our training programs in the last year, and perhaps to flag that, to channel that onto Anthony, because it does relate to this sort of this broader picture of how to combine these different elements together. We have the carbon pricing with its own distributional impacts, but we also have, of course, a whole sort of set of other climate-related or non-climate-related policies. You know, subsidy removal, you alluded to fossil fuel subsidies being removed, but also sort of support mechanisms for low carbon technologies. So how do you see sort of those coming together when of course the challenge at the end of the day is to come to a sort of general overview of how the distributional effects play out, when it's tricky to single out one particular element and say, you know, let's only sort of look and focus on this. If you could sort of share your thoughts on that one, that would be fantastic.
Oh, thanks a lot. And that's a good question. I think it gets back to the point I made before, is that it's not an either or. If you've got fossil fuel subsidies out there, they need to be reformed, and that will have a beneficial impact on the ability of a government to then introduce a carbon tax, but perhaps they package those up so that they can be seen as a mechanism that will have a joint impact rather than just doing it one at a time. And also the fossil fuel subsidies have an impact on different parts of the community as opposed to a carbon price, which will be much more widespread. Now, I think linking up to innovation is quite a interesting dimension as well, and I think it's quite good to look at them as a whole. It's not either or.
Excellent. Then by way of almost drawing this to a close, there's one question that I would like to throw in and to see if any of the three experts has a view on that, which goes to the current situation that we find ourselves in, where we've seen the natural gas price in Europe, I think, tripling over the course of a year, and therefore electricity prices in the rise, shooting up to levels where we've never seen them really. And this is all happening on wholesale markets, but of course it's only a matter of time before that starts feeding through into retail markets as well. And then, you know, we will see these prices as well also on our own power bills and on our own gas and heating bills and all the rest of that. And so it feels a little bit like we're setting up, you know, for a perfect storm to hit us in terms of, you know, energy costs going up tremendously. And that, of course, has a potential for a blowback to carbon pricing in Europe, but perhaps also in other parts of the world. And so the question to you would be: is there something that can and should be done basically now in the coming months that sort of countries in Europe brace themselves for the expected impact politically or economically to sort of cushion off some of these effects that we might be seeing? If any of you three has sort of good recommendations for what should happen now in the next weeks and months to anticipate that would be fantastic. Who wants to go first? Constanze?
I can start. I would say a big part is communication, mantra-like and very clear communication that the price increases are driven by markets, not the carbon price component. And there are quite I think, good graphics on that. And I think getting this beyond the geek community would be a really important first step. The second part is preparing assistance packages. This is already in the works. And thinking about how to cushion the impacts for those that are hardest hit, and this is subsidies to heating, so increasing social transfers, etc., and trying to make sure that this really reaches the breadth of that making use of existing mechanisms, but also making sure that the people feel it that need it.
Excellent. Anthony, do you want to come in on that one as well?
I can only agree with Constanze that it's all about communication. That you communicate early, you communicate often, you communicate hard. And also it links up to one of the poll questions you had at the start there. I think the fact that the consensus seemed to be that we need to make greater use of the social security system to achieve those social equity goals and try and keep the implications for the carbon price somewhat separate, or the compensation mechanism from the carbon price somewhat separate there.
Excellent. Ira, you're honored to offer any last concluding thoughts on this one, if you have.
Thank you. You definitely saved the hardest question for the end. Huh? So I think it very much emphasizes the need to speed up the transition away from to reduce the reliance on fossil fuels because of the price fluctuations. And I would, if I were to advise governments, I would really advise them to embrace the opportunity and not alleviate the price effect. And embrace the opportunity in a way that now price effects are very visible to consumers, and that is let's say a window of opportunity to incentivize retrofitting and changes in energy consumption patterns that can be supported by the state. And that I think we're at the end of time, but that would be something that also, given that we're still, let's say, coming out of the pandemic, there's still a lot of building back better money to be spent, also in the EU, but also in other countries, and that I would seize that opportunity.
Excellent. Many thanks, Ira, and many thanks to our three great panelists for a really rich and insightful discussion with full of new ideas and examples, facts and figures from different parts of the world, and also fresh ideas on how to think about these things and how to communicate them and what priorities to set. So I think it's really been a fantastic 90 minutes full of ideas and insights. Thanks also to the audience for staying with us and for many great questions that came in from the chat. I wanted to just sort of give a very quick outlook. Well, the first thing is we did talk about some issues that we already touched upon in previous episodes of this webinar series, and we're now in the nice position that we can sort of also have a bit of a back record of things already covered. So if you want to head out to ICAP-training.eu, you'll find there, for instance, a webinar we did on coal phase out and the just transition that sort of has overlaps to the topics we discussed today. We did look at the issue of revenue using revenue for emissions trading system that, of course, also is linked in some ways to the discussion that we've been having. And we had a separate episode on communicating carbon pricing. So just to sort of dive deeper into some of the things that we also touched upon in the last 90 minutes. And then a quick outlook to the next edition of this webinar series. So in 3 weeks from now, on Wednesday, 9th of February, we'll be looking at the legal implementation of emissions trading systems. So Michael Mehling and other experts will take us through some of the the legal groundwork that needs to be laid for establishing a smoothly functioning and durable ETS, and we'll introduce some of the basic legal considerations and explain how they've been tackled. Obviously also geared, will present in such a way that is accessible also for the non-lawyers, and particularly for those. And then we have another interesting format coming up. If we do have participant viewers from African countries, actually in mid-February, from 15th to 17th of February, we're organizing a workshop for how to make emissions trading work in African countries. You'll find out more about that very shortly on the website ICAP-training.eu. So in the coming days, we'll be publishing a call there, and then invite everybody who has some professional linkage to African countries to come in and join us for that workshop. On that note, then, many thanks for taking time and for a fantastic discussion. And well, let's stay tuned and hope to see you again in one of the upcoming webinar episodes. Many thanks and goodbye.
Thank you. Bye-bye.
Thank you. Bye-bye.